Now, when you talk about the characteristics of investment, what are the various characteristics of investment? Here, many people with many intentions, they make an investment, right? So, let us talk about different characteristics of making an investment, and these are the list of various characteristics as you make an investment, whether it may be a real investment or it may be a financial investment. But dear students, I tell you, or dear viewers, I will tell you that. So, from now, the perspective of learning this subject, investment management, is all about financial investment, right? So, think from the financial investment in think as a financial investor and learn this subject, okay, considering that you are making a financial investment and being a financial investor. So what is all about this investment and what are the various characteristics of investment? You please learn the subject from that perspective. Now when you talk about different characteristics of investment, first one is about risk. Second one is return, safety, liquidity, marketability, concealability, capital growth, purchasing power, stability of income, and then tax benefit. These are various characteristics. For example, risk. What is that first characteristic? Risk is, so the investment that you make, it is subjected to risk. Any investment, it may be a real investment or it may be a financial investment, that is subjected to risk. What is the meaning of risk? Risk is changes that happens in your expected return. You have some expectations in your mind, with that you will make a investment. Okay, in the future, the returns may be as per your expectations or may not be according to your expectations. There might be changes in your expected return. Then we say that is called as risk. The higher the changes, the more the risk of investment is. The lower the changes, the less is the risk of investment. If there is no changes, we say there is no risk. Okay, so risk is expected loss of your principal amount. Principal amount is the money that you are investing now, the money that you are foregoing now for your future benefits or future returns. That is called as the principal amount. So, the risk is expected loss of principal amount. Now, I take an example in this case. For example, I deposit some 1 lakh rupees, 5-year deposits that I make with bank. Now, as I make 5 years deposit with bank, there is no chance of risk of my investment. So the bank, they assure me that I'll pay you after 5 years the money they have promised. I can also invest in some treasury bills. Okay. So individual investors, they will not find much chance of investing in treasury bills. Usually banks will make an investment in treasury bills. But if at all I have a chance, the safest of the safest investment that we have in this India is investment in treasury bills. Maybe 91-day treasury bills or 180-day treasury bills, 361-day treasury bills. If we make an investment in treasury bills, the RBI will give me a guarantee that after 91 days or 180 days or maybe 365 days, the RBI or the whichever may be the authority assures you that definitely you will get your expected returns. Then in that case, I'd say that risk is zero. But if at all you make an investment in shares, or if at all you make an investment in some bonds, definitely some amount of risk is there in the form of expected loss of your principal. Suppose let me take an example of bonds. Suppose if you make an investment in bonds and the bond, whichever may be the corporates which have issued you the bonds, they promise you that I'll pay you 8% rate of return per annum, and the market rate is 6%. If at all market interest rates increases, naturally the value of the bond comes down. You bought a bond, each bond for 1000 rupees. If market interest rates increases from 6 to 7%, the value of the bond comes down to 800 rupees. That is called as loss of your principal amount. Okay. So that is as far as the bonds is concerned. When it comes to investment in shares, there will be a higher volatility of the returns on your investment in shares. You take Reliance stock, more volatility is there. You take some other stock, maybe some Wipro, maybe Infosys. So day before yesterday, the Infosys have announced the third quarter results. So naturally what has happened is the results were not as per the expectations of the investors. The market price of that particular stock has came down. So what is that? I mean to say that there is a higher amount of risk on your investment in stocks, right? So that is called as risk. So risk is all about expected loss of your principal amount. Now, what is return? This is for we make investment. Return is the money that we expect on our investment. Everyone will have some expectations, right? So, expected return from our investment, I expect, see, so over the years, stock market has given 15% rate of return. Okay. Now, with that expectations, I make an investment in stocks. In 10 years, 15 years time, the stocks has given a greater than 15% rate of return. No other investment has given that 15% rate of. So with that expectations, I have invested in stocks. So that we say it is called as a return. Okay. Expected return on every investment, okay, we will have some expectations. Even on bank investment also, we have an expectations that the bank will pay me 6% return after 5 years. As far as the share investment in shares is concerned, we cannot certainly expect that, yeah, the investment will give a return of 15% or 16% or 20%. Okay, if your fortunes are very good, if that company in which you have invested did well, naturally, your expected returns may grow or your actual returns may grow. It surpass your expected returns also. There are chances. So investing in Indian stocks, they have given better returns, right? So we say that is called as expected returns. Now, safety is very, very important. Safety is the protection of your principal amount. When you are making an investment, you should also see that how safe is my investment. Okay. So you should see that the principal amount, what you have invested, maybe 10 lakhs, 15 lakhs, whatever you make an investment, that has to be intact. That should not be decreased. Its value should not be decreased. That is the reason choose a wise investment alternative. Okay. So investment assessment is very, very important, right? Various investment alternatives we have. Before investing anywhere, please see that how it gives a return. There are these days, people are investing in bitcoins, cryptos. What is happening? The value of the cryptos over the period has came down. Earlier, before it has given better returns, but over the period we have, there is an erosion, steep erosion in the value of cryptos, right? So now you should make an assessment how it was, now how it is, as an investor in the future, how it may be probably how its value is going to be in the future. That assessment should also be made. Okay. So that is the safety of the principal amount that you are making. Next, liquidity is most important thing for any investment. As we discussed about the difference between real investment and financial investment, which is more liquid, I say that investment in financial assets is very liquid when compared with reinvestment in real estate or real assets, because there will be less takers of that particular real asset in which we have invested. But as far as the financial asset is concerned, you can sell that financial asset very, very equally, very easily in the market, and can encash that asset into cash. That is called as liquidity, ready to convert into cash as and when we require, as and when we wish. Okay. So that flexibility is there in financial investments when compared with the real investments. Marketability, transferability of assets in the name of other person. Suppose you are the title owner of the company. Now, easily, if you could able to easily transfer the name, the ownership which is there in your name on the other people, then we say on the buyer name, then we say it is called as transferability. So your investment has to see that it is marketability. Marketability is there on your investment, right? So these two are very, very important properties. Next, concealability. Okay. So you should see that in many cases, what happens is you want to make an investment and do not want to project it that you had made so much of investment, so that the government will come to know about your investment and confiscate the property on what you have invested. So you say that this is concealability. You want to hide your investment and do not want to show to others that this is the investment I have made. Okay. So why? Because you want to evade the tax, or you do not want to make the government know that this much amount of money you had made a investment. So this is another feature of, or another characteristic of an investment. So where we can invest in such a case, where the people invest in India, especially the people, they prefer to invest in gold. They want to see that they invest in gold and they want to keep with them in their safe lockers, so that how much they have invested in gold doesn't the government officials and other people, they could not able to know it. Okay, and as I tell you that gold is the safest metal, whatever happens in the market, the value of the gold or the price of the gold remains intact. But the stability of the growth is quite normal when it comes to appreciation in its value is concerned, right? So that is the reason we can say investment in safe metal or yellow metal, with which what happens is there is a feature called as concealability. And then a capital growth, appreciation of investment. We call in finance as capital gains. The money that you make an investment, it has to increase in its value. The investors will not be very happy. I make an investment of 1 lakh, and after 5 years, if I see that its value is only 1 lakh, people will not like it. They want to see that its value has to appreciate. That is called as capital appreciation. We also name it as capital gains. So the main objective of making an investment is they want to see that the capital in its value, it has to grow. Okay, that's the reason many people in India, they prefer to invest in real estate because it gives better return when compared with any other investment alternative. No matter they take now the higher risk, because when you invest in real estate, naturally the value of that investment will be usually very high. So for that, they may use their money, or they may use their borrowed money, or they may use some other money. Okay, they may borrow from bank, or they may borrow from other sources, and they make an investment. On that borrowing, they have to pay interest also. So they want to see that the return that on the investment will be higher than the borrowing rate. So that we say it is called as capital growth. In the market, we usually observe this. Purchasing power, buying capability of the people increases. See here, I want to bring to your notice now why people make an investment, because they want to beat the inflation. Now, what is this inflation? Inflation is increase in the value of the or decrease in the value of money. Now, I give an example to make you better understand what is this inflation is. Suppose I buy, okay, these two things for 100 rupees now. These two are the markers. Okay, so this usually I use to write it on the board, right? So I buy these two things 50 and 50 for and its total value is 100 rupees. I buy these for 100 rupees. Now, if I want to buy these two markers after 4 to 5 years, do I get for 100 rupees? No. So at that time, I have to pay some 150 rupees or 160 rupees to get the two markers, because the value of the money comes down. I need to shell out more money to get the same product. Then we say that is called as inflation. Now, what is that point I am driving towards is, now today I have some money. In India, the inflation rate is 7%. Annual inflation rate is 5 to 7. It's hover around 5 to 7%. For the past 5-6 years, okay, it is in between 5 and 7%. Now, the value of money every year is coming down by 5 and 7%. Okay, so every year I have to see that the return on my investment has to beat the inflation. It has to be more than inflation. Okay, so I make an investment in such a way that my investment grows in such a way that it beats the inflation, and naturally as it beats the inflation, my buying capacity will also increases. For example, let us take I invest in shares. As I invest in shares, if I get 12% rate of return, which is more than inflation rate is just 5%. Now in this case, I'm getting a higher amount of what the inflation is, that is 7%. With that, my buying capacity will also increases. Okay. Now let us take another example. I'll tell you a different scenario here. I have some 1 lakh with me. I do not want to make an investment. I want to keep or hold that 1 lakh rupees without making a investment. And the inflation rate is now 5%. Now what happens after 1 year? The value of money decreases. Now I need 1,05,000 to pay for some amount, to get some products. With 1 lakh, which I used to get before 1 year, now I will not get any product. I need to shell out 1 lakh 5 rupees, 1 lakh 5,000. So this is an example. If you want to beat the inflation, you need to invest in some investment alternatives which pays you a higher amount of return, which is over and above the inflation rates. Thereby what happens is your buying capacity will increases, right? Next is stability of income. We want to see that, in some cases, suppose if you invest in bonds, naturally bonds assure you that every every year it will pay as promised some annualized return, constant amount of return. Thereby what happens is you will get stability of income. So different investment alternatives, they give different amount of return. Okay, so bonds gives you assured amount of return, and then we have debentures. Debentures will give you the assured amount of return, and if you deposit in with some banks, banks will also pay you the assured amount of return, right? So this is how you will get stability of it. See, investment in different investment alternatives, they are subject to different amount of risk and different amount of return. It all depends upon the individual investor and the company in which the company which is making an investment. With different objectives, they will make a investment, right? And tax benefits, many cases what happens is they want to see that the investors or the companies want to see that they want to um, they are not burdened with paying taxes. Let us take me as an example. See, uh, I have to pay tax for the income which I get. Now, there is some clause in the as per the income tax law. What is that clause is? If I show some deposit as per section 80D or section 80C, I will be waived from not paying the tax. For example, if I take my child plan insurance policy, or if I make some type of mutual funds where there is some tax benefits, I can show it that as my savings. And if I on that particular savings which I have made, I can be benefited to the extent of my investment by not paying the taxes. This is the reason why many people, especially the salaried people, make an investment to see that they are waived or they are not burdened with by paying the taxes. They get some amount of tax benefit. So these are the various characteristics of investment, the investments that we are making. So this the behind motto or behind reason of making an investment is these are some of the motto or characteristics of making a investment, or your investment carries all these features.